Hi, I'm Joanna with Insights, and welcome to the first video in our five-part series designed to make investing feel simple, smart, and totally doable. Let's dive in. Ever wondered how regular people actually build wealth in the stock market, not just the pros on Wall Street? Most beginners think it's all about picking hot stocks or following expert tips, but that's exactly why 90% of new investors lose money in their first year. Stay till the end, because I'll give you the single most important mindset shift and the actionable steps most beginners never learn. Here's the shocking truth: successful investing isn't about predicting the next big winner, it's about understanding what makes companies actually valuable. Most new investors get caught chasing hype and stock tips without understanding real company health, which can lead to painful losses. They see a stock jumping 20% and think, I missed out, then chase it right before it crashes. But here's what smart investors know: before you buy any stock, you need to check three critical things. First, is the company actually making money? Not just revenue, I'm talking about real profits. Second, can the company pay its bills from cash and near cash items? Third, is the company preserving shareholders' equity? These are the real signals of long term winners, not just price spikes or social media buzz. In fact, smart investors use science backed tools that reveal a company's financial health instantly, so they buy and hold only the strongest companies. Companies like Microsoft, Apple, and Johnson & Johnson didn't become wealth builders overnight. They consistently passed these three tests for decades. With just these basics, you can protect your money, avoid hidden risks, and start making educated decisions right away instead of gambling on hot tips. Want to know the next step? I'll show you how to actually buy your first stock safely using these exact criteria in part 2. Follow for more. And if you want to see the checklist I use to find strong stocks, drop a stocks in the comments.